Alright, so today we are going to solve a question on published account, a past question on published accounts. Alright, then tomorrow we start with consolidated financial statements. Alright, so I'm going to read this is ICA July 2023. Alright, so this is a past question. So we are going to see how to go about this question. Question 3. Biposu Limited is an agro-processing company whose head office is in the Greater Accra region of Ghana. The trial balance of the company for the year ended 31st December 2021 is as follows. So we have revenue, cost of sales, administrative expenses, other operating expenses, non-current assets, inventory, trade and other receivables. We have trade payable, cash and bank balances, share capital, retained earnings, revaluation surplus, provision for tax, deferred tax. Additional information. I. Included in the revenue figure is sales made on special arrangements, payable by customers in 2 years' time at an amount of 16.8 million cedis. The cash price of the sales at the date of the sales, 1st January 2021, is estimated at 15 million cedis, and the effective interest rate of the arrangement has been computed as 5.83% per annum. II. Non-current assets are made up of the following classes of assets: building, motor vehicles, machinery and equipment. The company revalues its buildings at a time interval sufficient to keep the current value close to its fair value on the market. The buildings were revalued at 31st December 2020 at 198 million, land component 80 million. The revaluation surplus shown in the trial balance represents the revaluation difference arising on the revaluation of buildings at 31st December 2020. All buildings were completed for use on 1st January 2011. The company's buildings are administrative offices and production centers. The estimated useful life of the company's buildings is 50 years. The company relocated from one of its administrative offices and consequently sold the building for 27.6 million on 1st April 2021. The revaluation and the revaluation amount and the revaluation surplus on this building at 31st December 2020 were 25 million cedis, land component 5 million and 8 million respectively. The remaining land and buildings were revalued on 31st December 2021 at 169.35 million, land component 85 million. It is the policy of the company to realize revaluation surplus only upon the recognition of the non-current asset. The disposal of the building and the current year revaluation of the remaining buildings are yet to be recorded in the books of the company. The consideration for the disposal of the building was received in the first week of January 2022. There were no other changes in the value of the property, plant and equipment for the year ended 31st December 2021. The trial balance excludes depreciation expense for the year ended 31st December 2021 on all non-current assets. Depreciation is charged to cost of sales. Motor vehicles, machineries, and equipment are all depreciated over 5 years useful life. III. In lieu of cash dividend payment, the company on 1st January 2021 issued bonus shares of one new share for every 10 existing shares held at the agreed price of 1 cedi, subject to 8% withholding tax on capitalization of dividends. The 8% tax withheld has been paid by the company, and it is included in administrative expenses. The bonus shares are yet to be recorded. The bonus shares are in respect of the year ended 31st December 2020. The board of directors of the company has, however, immediately after 31st December 2021, proposed dividends of 80 pesos per share in respect of the year ended 31st December 2021. Shareholders are yet to approve the proposed dividend. Provision for tax represents the under or over provision of tax by the company, arising from differences in the tax provided for the year ended 31st December 2020 and the actual tax liability arising from tax audits for the 2020 year of assessment. Current tax for the year ended 31st December 2021 is estimated at 16.7 million. Taxable temporal difference arising from differences in carrying amount of assets and liabilities against their tax basis as at 31st December 2021 have been computed at 60 million. Corporate tax is 25%. Required. Prepare the following statement. Prepare the following financial statement of Biposo Limited for the year ended 31st December 2021. A. Statement of profit or loss and other comprehensive income. Statement of changes in equity. Statement of financial position as at that date. 20 marks. Okay, so there we have it. We have our question, and let's see how we are going to do about it. Okay, so
It's very loaded.
I tell you, it's very loaded. In fact, uh, so in exams, you have to take your time and handle it one by one based on how you understand it and the ones you can do. You know, the ones. So we are going to start with the format. And with the templates so that we know how to know about it. The balance sheet. So first, let's try and go through the trial balance and determine determine the assets, determine the items that will go to balance sheet and those that will go to P&L. Okay, so revenue will go to. So let's start with the balance sheet first. So we will start with the name of the company, Biposo Limited. So Biposo Limited. So we start with statement statement of financial position as at the 3rd December 2021. Okay, so we have our assets. Non-current asset. The non-current asset we have. Okay, it's here. It's only one. Okay, so let's go to current asset. Current asset we have inventory, trade and other receivables, cash and bank balances. I think that's it. Okay, let's go to equity. We have share capital. What else do we have? We have retained earnings. What else? We have revaluation surplus. Okay, let's go to non-current liabilities. Non-current liabilities. Do we have any? Okay, we have deferred tax. Current liabilities. We have trade payables. Okay, now we have our templates. Okay, let's look at the profit or loss. Okay, so we have revenue, cost of sales, gross profit, administrative expenses, other operating expenses. Okay, so let's see. Okay, I think that's it. Okay, so now let's come to our workings. So with the workings, you need to look at the ones you can do first, the one that will be easier for you. Okay, so you don't have to start from I to the last note. The first note to the last note. You can start from anywhere. So when we go through it, usually we start with the PP. Okay, so let's tackle the PP and see. That's where all the work is. Okay, so look at the PP. Non-current assets are made up of the following classes. We have land, building, vehicle, machinery. So we have their cost, accumulated depreciation, and their carrying amount. So these are the opening balances as at December 2020. So this is the carrying amount as at December 2020. Okay, so let's read the notes. The company revalues its buildings at a time interval to keep the carrying value close to its fair value on the market. The buildings were revalued at 31st December 2020 at 198 million. Land component 80 million. Okay, so that is why it is here. Okay, and the land is the revaluation surplus shown in the trial balance represents the revaluation difference arising on the revaluation of the building at 31st December 2020. Okay. All buildings were completed for use on 1st January 2011. So that's the acquisition date. The company's buildings are administrative offices and production centers. The estimated useful life of the company's building is 50 years. The company relocated from one of its administrative offices and consequently sold the building for 27.6 million. Okay. On 1st April 2011. The revaluation amount and the revaluation surplus on this building at 31st December 2020 were 25 million. Okay, land is 5 million. And 8 million respectively. The remaining land and buildings were revalued on 31st December 2021 at 169.35 million. It is the policy of the company to realize revaluation surplus only upon derecognition of the non-current asset. The disposal of the building and the current year revaluation of the remaining buildings are yet to be recorded in the books of the company. The consideration for the disposal of the building was received in first week of January 2022. There were no other changes in the value of property, plant and equipment for the year. The trial balance excludes depreciation expense for the year ended on all non-current assets. Depreciation is charged to cost of sales. Okay, so I think most of the work is on the land and building. Okay, so they said as at 31st December 2020, the building, the land and the building was revalued, and this is the revalued amount. Okay, but it was sold. It was sold in on 1st April, or some of the parts of the building was sold on 1st April 2021. Okay, so there was a disposal. Okay, so let's work on the land and building. So land and building. Okay. So let's look at the revalued amount on 31st 2020. Oh, there's the opening balance. Okay. So how much was it? So it's 198,000. Okay. And there was some disposal. Okay. There was a disposal. So let's work on a disposal. Then we'll come and look at. Okay. So let's look at a disposal. So they said the company relocated and sold. The company relocated from one of its administrative offices and consequently sold the building for 27.6 on 1st April. The revaluation amount and the revaluation surplus of this building at 31st December were 25 million and 8 million. So the revaluation amount of the building that was sold was 25 million. Okay. So it means disposal is 25. Okay. The disposal was on 1st April 2021. Okay, so that means as at 31st December this 2021, this is the value of our land and building. Okay, not yeah, let's say there's a balance of the building after the disposal. Okay, right. There's a balance of our building after the disposal. Now, whenever there's a disposal, we have to calculate profit or loss on disposal. Okay, so we have to calculate profit or loss on disposal. Okay, so the profits or loss on disposal, it is the selling price minus the carrying amount. Okay, the profit or loss on disposal is equal to the proceeds minus the carrying amount. That will give us the profit or loss. So, how much was the proceeds? Okay, so the question said the company relocated from one of its buildings and sold the building for 27.6 million. So this is the proceeds. 27. Now we need to know the carrying amount. The carrying amount on the date of the disposal, 1st April 2021. We need to know the carrying amount on this date. So how do we determine the carrying amount? Okay, so we know that the building that was disposed, on 1st January. Let me come here. On 1st January 2021, Okay, this building had a carrying amount or revalued amount 25 million. This one. Okay, that was the revalued amount at the beginning of the year. So we have to depreciate it from January to April, January, February, and March. Sorry, up to 3 months because it was sold on 1st April. So you have to calculate 3 months depreciation on it to get the current amount as at um so depreciation in January to March, 1st January to 31st March. Okay, so to calculate the depreciation, we need to know the useful life. Alright, so let's go and look at what is the useful life of this building. The estimated useful life of the company's building is 50 years. Okay, the useful life is 50 years, and the building was built on 1st January 2011. Okay, so whenever there's revaluation, you have to update the useful life of that asset. So, for instance, if an asset has a useful life of maybe 10 years, okay, on 1st January 2021, okay, let's say 2020, and then we use it for, let's say, 2 years, and we revalue it on 1st January 2022. Okay, we have used it for 2 years. Okay, now we are no longer going to depreciate this building over 10 years. We are going to depreciate it over what? 8 years. Do you get it? Because we have used 2 years already. So now the remaining useful life is 8 years. So anytime there's revaluation, we have to use the remaining useful years to depreciate the assets. Do you get it? So from our
All right.
question, yeah. So from our question, we're told that the building was acquired on 1st January 2011. So we need to know how many years the building has been used so that we can know the balance. Okay, 2011, 1st January 2011, and then they disposed it on, sorry, they did the revaluation on 31st December 2020. Okay. So how many years? So we have um, December 2011, December 2011,
To be 10 years.
it will be 10 years. Okay, yeah.
Let's check.
Yeah, okay, December 2011 is 1 year, at end of the year, 2 years, all the way to, what is it? I thought December 2011, December 2012, December 2020, 2013. Eh, but yeah, I'm sure it will be 10 years, but let's see. Okay, so 1 year, 2 years, 3 years, 4 years, 5, 6, 7, 8, 9, 10. Yeah, 10 years. So it means, so that means the useful life will be 40 years. Okay, because the initial useful life is 50 years. So the remaining useful life is what? 40 years. Okay. So it means we are going to depreciate the building over 40 years. Okay, so that means the depreciation will be 25,000 over 40, okay, multiplied by, this is, we are depreciating it for 3 months. So it will be 3, 3 over 12, 3 out of 12 months. Okay, so we are getting this. Okay, so the carrying amount on the date of the disposal is this 24,000. Yeah. So now we can determine the profit or loss. Okay, so now our proceed is this. Our carrying amount is this. So our profit or loss on disposal is this minus this. Okay, that's 2,700. Okay. Okay, so we are making progress. Okay, so now we are still on the building. So now 25,000 is out. We've sold it. We left with this. Okay. Okay, let's continue. The remaining land and buildings. So that means the land and buildings that were not sold, the ones, so they are referring to this 173,000, the remaining land and building. The remaining land and building were revalued on 31st December 2021 at 169,300 Okay. It is the policy of the company to realize revaluation surplus only upon the recognition of the non-current assets. So it means that this statement means that the revaluation surplus in relation to the building that we sold, we have to include it in our retained earnings as income or as a form of income. That's what it means. Okay. Once the building has been realized, then that revaluation surplus in relation to that building is also realized. So we have to treat it as income. All right. So we'll get there. Okay. But let's look at the remaining building. So the remaining land and building. Okay. So the carrying amount of the remaining land and building as at 1st January 2021, okay, is 173,000. Okay. Then we have to depreciate it. Okay. We also depreciate it over 40 years. Okay. Just like what we did for because they are all the same. They are in the same class of assets. So we also depreciate it over 40 years like this. Okay. Okay. So the depreciation is going to be 173,000 over 40. Now this one, it's a full year depreciation, right? Because this building was not sold. The remaining was in existence for the whole year. It was not sold. So we'll do a full year depreciation for it. Okay, so we'll get the carrying amount as at 31st December 2021. Okay, so it will be this minus this. Okay, then we'll compare it to the revalued amount. we're told that it was revalued. So how much is the revalued amount? The remaining land and buildings were revalued on 31st December 2021 at 169.35. So 169,350. Okay, so there's going to be a revaluation surplus. This minus this of 675. Okay, so this is our revaluation surplus of the. Okay, so now at least we know that this is going to be our carrying amount of the building, of the remaining land and building, 169,350. So we'll come and, okay, I think we are not done. Left with the what's the name? With the motor vehicles and machinery. Okay, so but we are done with the land and building. Okay. There were no other changes in value of the property, plant and equipment for the year ended 31st December 2021. Okay, so this one is cool job for us. So there were no changes. So we can easily do it. So motor vehicles. Let's start with the motor vehicles. Okay. So already the carrying amount at the beginning of the year. Okay. At um 1st January 2021. Okay, is 5,020. I mean, you can start from the cost, accumulated depreciation, and all that, but it's a long process. You can just start with the carrying amount at the beginning of the year and calculate the depreciation charge to know the carrying amount at the end of the year. But you can also start from the cost minus the accumulated depreciation and you get the carrying amount before you calculate the depreciation charge for the year. And but since they've already given this to us in exams, we don't have time to be repeating ourselves. So we'll start with the carrying amount at the beginning of the year, which is 25,020. 25,020. Then we'll calculate the depreciation charge the year. We need to know the useful life of this vehicle. Motor vehicles, machineries, and equipment all are depreciated over 5 years. Okay, so uh, we divide it by 5. No, no, not by 5. We divide the cost by 5. There's a cost that we divide by 5. This one. 41,700 or 5. Okay, this is straight line, so it's on the cost. Okay, so 5 years. So we have the carrying amount at the end of the year. So the carrying amount 31st 12 2021. Okay, so we have this. Let's look at the equipment, machinery and equipment. So that's 18,600. Depreciation charge, the same 5 years. So it will be on the cost. So it will be 20,400. So the current amount is this minus. Okay. So at the end of the day, our PPE, property, plant and equipment, our non-current assets, is um, going to be this plus this plus this. Have you seen it? So it will be the revalued amount for the remaining land and building plus the motor vehicles plus the machinery. So it will be 550. Okay, so I will put it here. Okay, inventory. I didn't see any notes on inventory, so we can put it the 3rd December 173,700. 173. Cash and bank. I didn't see any. 823050. 823050. I think trade receivable. You may have to. Okay. Okay, so we have dealt with. Alright, the next thing we have to put together our depreciation charge. Okay, depreciation and then PP go together. Okay, so we have to add all our depreciation that we have calculated. So they said the trial balance exclude depreciation for all the non-current assets. Depreciation is charged to cost of sale, so we have to add depreciation to cost of sale. So let's add all our depreciation. So let's start with the motor. Okay, let's start with the building. Okay, the building. Let's start with the building disposed. The building that was disposed, we used it for 3 years, 3 months before we sold it. So there was a depreciation for 3 months. So we have to remember that. Where is it?
You passed it. It's here.
Yeah, this one, yeah. 156.25. So we have to bring this here. 156.25. Then the building itself, the remaining one, the depreciation for the remaining building. So that one is also, where is it? Is this one? 4325. Then our motor vehicle. For the motor vehicle, the depreciation is this. Then our machinery, the depreciation is this. Okay. So this is and what the name is machinery and equipment. So we have to add everything. So this is our total depreciation for the year. So they said we should add it to cost of sales. Okay, so when we are doing cost of sales, we will add it. Okay, so we have dealt with this. Okay, what else can we do? Okay, we can do tax. Well, tax is not difficult. So let's work on okay. Provision for tax represents the under or over provision for the tax by the company, arising from differences in the tax provided for the year ended 31st December 2020 and the actual tax liability arising from the tax audits for the 2020 year of assessment. Okay, so let's go and look at the provision for tax. Okay, in the trial balance. Okay, it's here. Okay, so the provision for tax, they are saying it refers to under or over provision of the previous year's tax provision. Okay, and since it's at the debit side, what do you think? Is it under provision or over provision? Can you try?
If it's at the debit side, then it's an asset.
Yeah. So is it
So it's over.
uh oh no, it's under provision.
And
Uh-huh.
that provision. Oh, okay, okay,
Yeah, if it's at the debit side, it means it's under provision. It means it's an expense.
okay,
It's an additional expense.
okay, okay,
Yeah, expense has a debit. Expense and assets have a debit balance. If it if
okay.
it's
All right.
if it's credits, it means it's our provision, which means it's credit. So credits. So for instance, let me give you let's do a simple illustration. Let's say 2020, we made a tax provision of um, maybe 3,000. Okay. Then in 2021, when GRA came, they said we should pay 4,000. Okay. And I remember this provision that we did in 2020, the double entry will be like this. So we'll debit our income tax expense of 3,000. Then we'll credit the tax provision. This is going to be a liability.
Okay,
Yeah. So that is 2020. The initial entry we made for the provision. So that's 31st December 2020. Okay, now GRA came, they said we should pay 4,000 instead of the 3,000 we provided. So we paid the 4,000. So if we paid, it means we have the credit cash of our bank of 4,000. Okay. Then we have to debit this tax provision. Okay, this,
mm.
but it's 3,000, so we can only debit it by 3,000. We can't debit it more than you get it. So there will still be a difference of 1,000. So that 1,000 will be a debit for income tax. Mm, yeah, that 1,000 will be a debit for the income tax. And the provision will lead to a debit to the income tax expense account.
Okay.
But over provision will be a credit to the income tax expense account. So that's how it works. So it means in this question, it's under provision.
Thank you.
Okay, you're welcome. Yeah, which is 588. So 588. So then we have to look for the provision for the year. Okay, so let's continue. So we have the current tax for the year ended at the 1st December is estimated at 16.7. So usually the tax note format is almost the same. It's almost the same in all the questions you see. They will give you they will talk about the provision for they will talk about under or over provision for the previous year. Then they will give you the current year provision. Then they will talk about deferred tax. These are the main things they talk about. So if you know how to do it, it's very easy. So when you check your under over provision, then you come and check your current tax provision for the year. Okay. So the current tax provision they said it's 16.7. So 16, is it like this? Um, okay, 16.7. Okay, then we have to check for deferred tax issues. Okay, taxable temporary differences arising from differences in carrying amounts of assets and liabilities against their tax basis as at 31st December 2021 have been completed at 60%. Okay, so this, when you see, with deferred tax liability, sometimes they will say the carrying amount of an asset is more than the tax base by a certain amount, then you know it's a deferred tax liability. But here they didn't talk about carrying amounts or anything. But they mentioned taxable temporary difference. So when you see taxable temporary difference, it also means deferred tax liability. Remember. So we have taxable temporary difference and deductible temporary difference. Okay. Taxable means an amount that will be taxed. So it's a liability that uh, we have to account for. Deductible means it's something that it will be like a credit to us. Okay, so deductible temporal difference is an asset. It's a deferred tax asset because deductible means it will be a credit to us. We will deduct it from the tax we have to pay in the future. But taxable temporal difference means it's an additional tax we have to pay in the future. So that one is deferred tax liability. Okay, so here what they are talking about is deferred tax liability. Okay, just a minute.
like or that year as well.
Okay, so here they are talking about deferred tax liability. Okay, so let's continue. Okay, so they are talking about deferred tax liability. Okay, so now we need to know the amount. Okay, it says it's 60 million. Okay, taxable temporal difference from the arising from the differences in the current amount of assets and liability as against their tax basis. Okay, is this corporate tax is 25%. So we have to so that would be 6123 multiplied by 25%. Okay, so we have this. So now we have to check whether there's an increase or decrease in the fair tax liability. So we have to look at the opening balance. That it will help us to know. Okay, now the fair tax as at 31st December 2020 is has a credit balance of 17,150,000. Okay, this is okay. So which is the liability for the year for us as or the opening balance deferred tax liability. All right, so 17,150. So opening balance 17,150, and now the closing balance is 15. So there's a decrease. Yeah, there's a decrease in the fair tax. So it has reduced from 17 to 15. It has reduced by what? 2,150. So we'll bring it here. Decrease in the fair tax. Okay. So since it's a decrease, it will be a reduction. Okay. It will be negative by this. Okay. So now we know our income tax expense. Okay. So the income tax expense is this. Okay. So that's what we show in our profit or loss. So okay, so you have dealt with this. Okay, this is what dividend. Okay, let's deal with this. Included in the revenue figure is sales made on a special arrangement, payable by customers in 2 years' time at an amount of 16.8. The cash price of the sale at the date of the sales, 1st January 2021, is estimated at 15 million, and the effective interest rate of the arrangement has been computed at 5.83%. Okay, so the company made some sales, but this sales is going to be paid in 2 years' time. Okay, the customer will pay in 2 years' time, and in 2 years' time they will pay 16.8. Okay, in 2 years' time they will pay 16.8 million. Okay, but the cash price of the sale at the date of the sales is 15 million. What it means is if they were paying it outright, if the customers were paying it outright, they would have paid 15 million. But because they are going to pay in the future, that's why they are paying 16.8. Do you get it? So it means the difference is interest. I hope you agree with me. Whenever
Yes.
the sale is going to be settled it's going to be paid in the future, there's an interest component. Yeah. So it means that the actual sale should have been 15, but because they are going to pay 2 years time, it will just. So but they have included this figure in the sales. They should have rather included this. So it means we have to revise the we have to adjust the revenue figure, the revenue and the trade receivable. This because the credit sale, this transaction will affect revenue and then the trade receivable. So we have to adjust it. So we have to revise this whole transaction and input the right, do the right adjustment. Okay, so we can do it here. So we have to adjust revenue and okay. So to adjust, we have to debit revenue. Revenue is credit, so we are reversing it. So to reverse it, we have to credit revenue by 16.8. But this is the mistake they did. So we are reversing it. Then we have to credit trade receivable. Trade receivable too, it has a debit balance. So if we are reversing, we have to credit it minus. Okay. So we reverse. Then we will do the right thing. Okay. The right thing we should have done is that we should have credited revenue by how much? By 15 million. Then trade receivable by 15 million. Okay, so that's what we should have done. Okay, now the interest components. The interest is the difference between so the interest is 16,800 minus 15. Okay, this is the interest. This minus this 1008. Okay, so this is going to be our interest receivable. Okay, let me see. So okay, so this interest, okay, will be received at the end of the period, at the end of the 2 years. That's where the interest will be received. Okay, so what we have to do is we need to, so the sale occurred on 1st January and we are reporting on 31st December 2021. So it means we have spent 1 year. So it means we have to recognize interest for the first year. The interest end for the first year. Okay, so how do we recognize the interest end for the first year? Okay, so let's do something here. So year zero, as at zero, 1, 2. Okay, so you mean what this amount, okay, this 16.8. The 16.8 is the future value of this amount. The 16.8 is the future value of 15 million using 5.83 as the interest rate. Okay, it also means that the present value of this amount is this. The present value of 16.8 to be to be received in 2 years time is 15 million. So look at something here. Okay, so we want to find the present value of 16.8, okay, in 2 years time. Okay, so 16,800, okay, over 1 plus so we have to discount it. 5.83, 5.83% raise the power. How many years? 1, 2. As at year zero, beginning of or at the time of the transaction, we have 2 years. So raise the power 2. Raise the 2. So how much are we getting? See, you can see that it's almost the 15,000 that we are looking at. Okay. So at the end of year one, we need to find the present value of this amount at the end of year one. It will be 16,800 over 1 plus how much is that? 5.83%. 5.83%. Okay, now elaborate 1 year. Raise the power 1. Okay, we only have 1 year here. Then here, At the end of the 2 years, it will be 16,800 over 1 plus 5.83 raised to the power 0. Okay, so we get this. Okay. So what it means is that at year 0, we have to recognize with sale of 15,000 and receivable of 15,000. But at year 2, okay, the amount is going to increase. We have to recognize sale of 15,000, all right, but we have to recognize finance income or other income. Okay, you can see there's a difference between this and this. Okay. So the sale is still 15,000. There's no doubt about it. But the difference, you can see it has increased by 874. This 874 is the interest on it. Okay, so this will be treated as other income. When we come to year 2, you can see it has also increased a bit. So this minus this. Okay, when you add these two together, you should get this. You should get the interest for the whole period. So if I add this plus this, you see it's giving me this. So what it means is that this interest, okay, we are going to recognize it over the period. Okay, we are not going to recognize the full amount at the beginning of the year or at the time of the transaction, but we will recognize it over the course of the or as time elapses, okay, or with time. So what it means is that at year 1 or 31st December 2021, this is the interest income we recognize. I hope you get it.
Yeah. The only challenge is that if you had not done this thing, as exams, I would have just taken 1,800 and split it into two and
Okay.
take the other half for the interest.
Yeah. Yeah. I mean, at least it's close. I mean, which is 900. Yeah. I mean, it's at least the examiner will give you some points. The examiner will think that you have a fair idea. Uh-huh. But in exams, okay, when you are determining the interest for the interest that has accrued for the period, okay, you don't have to do this calculation I've done. Okay, all you need to do is you find the present value, which is the 15,000. You multiply it by the interest rate, 5.83. Okay, it will give you this. Okay, so if I multiply this by 5.83%, 5.83%. You see, I'm getting 874. Yeah, you see. So in exams, you just need to multiply the rate by the present value to get the interest that has accrued for that period. But here, I just wanted to demonstrate to you how the figure is coming from. Okay, yeah. So this will be for year 1. Okay, this is year 1. Assuming in exams for year 1, this is what you do. For year 2, okay, year 2 you cannot do the same thing like multiply this by 5.83. No, you can't do that. Year 2, what you do is that you add this to this. You add this to this, then whatever you get, then you apply the weight on it. So it will be this plus this. Okay, you get this. Then you apply the rate on this amount rather. So you apply it this multiply by 5.83. 3%. Is the 925.48, which is here. You see, yeah. So that's how. So it means that for the first year, you can multiply the rate by the present value. But the subsequent year, it's cumulative. So assuming that we're doing year 3, you would have added this to this, and then you apply the rate on it to get the amount that's accrued for that period. Yeah. So this is how to go about it in exam. Multiply the present value by the rate, and you get the interest that has accrued. Okay, so that's how we go about it. Okay, so now we have to recognize interest receivable of 874. Okay, so we can do our small double entry here. But example, you don't need to be doing this double entries. This you can quickly you can straight away put it up. I mean, put it in the account. Okay, so this will go under trade receivable. So it's going to be a debit. Okay, then here will be interest finance or interest income. Okay, it will be this like that. Okay, so trade receivable interest income. Okay, so
I'm here.
okay. All right, let's continue.
Okay.
Yeah, so we have dealt with our our eye. All right, so let's look at what else is left. I think the last one is I. In lieu of cash dividends payments, the company on 1st January 2021 issued bonus shares of one new share for every 10 existing shares. For every 10 existing shares held at an agreed price of 1 cedi, subject to 8% withholding tax on capitalization of dividends. The 8% tax withheld has been paid by the company and it is included in administrative expenses. The bonus shares are yet to be recorded. The bonus shares are in respect of the year ended 31st December 2020. The board of directors of the company has, however, immediately after 31st December 2021, proposed dividends of 0.8 cedis per share in respect of the year ended 31st December 2021. Shareholders are yet to approve the proposed dividends. Okay, so this is in relation to bonus issue. Bonus issue. So, when we're doing earnings per share, we talked about bonus issue. Okay, so bonus issue is when you issue shares for no consideration. I mean, the shareholders don't pay for the shares. Okay, so let's see how we'll go about it. Okay, so we know that the company issues shares, one new share for every 10 existing share. Okay, this information is important. We need this to determine the number of bonus shares issued. One new share for every 10 existing shares. So this is 1 for 10. Okay, 1 for 10 shares. So how many shares will come out of this bonus issue? So we need to know the number of existing shares. So that will tell us how many shares. So share capital. Okay, so they said it's 1 cedi each. So it means they have 900 million shares. 900 million shares. Yeah. So we are going to divide 900 million over 10 because 1 for 10. Okay. So how many shares are we going to get? I hope it's 900, 1, 2, 3, 1, 2, 3. Okay, so that will give us 90 million. So that's 90 million shares. Okay. So 90 million shares. And the price for each share is 1 cedi. Okay, the price for each share is 1 cedi. So that means when we value it, the value of the 9 million shares, value of bonus shares, yeah, is the same 90 million, but here it will be 90 million cedis. Okay, yeah, 90 million cedis. So what will happen is that we need to do our double entry. Okay. So whenever there is a bonus issue, okay, it's between retained earnings and then stated capital. These two accounts are affected. Okay, bonus issue is issued out of retained earnings, okay, and then it goes to affect the stated capital. Okay, so we have to debit retained earnings because retained earnings will reduce. Then we'll credit stated capital because stated capital will increase. Okay, so that's how it's going to look like. All right, but there was a withholding tax issue. Okay, the company had to pay withholding tax of 8%. So it means even though this is the value, they had to pay withholding tax. So that will reduce the Okay, so withholding tax is 8% of this amount. So at the end of the day, so this will be the withholding tax, 8%. Okay, so let's see something here. The 8% tax withheld has been paid by the company, and it is included in administrative expenses. Okay, now the question is, should it be included in administrative expenses? The bonus shares are yet to be recorded. The bonus share are in respect of the year ended 31st December 2020. Okay, so they are saying the withholding tax, it has been included in administrative expenses. So let's look at something here. Okay. So we are going to debit retained earnings by 90 million. Okay, 90 million. Okay. Then we are going to credit we are going to credit stated capital by we are going to credit stated capital by what was the name? Okay, so after paying the withholding tax, what will be the balance? The balance will be this minus this. Okay, so that's the balance after paying the withholding tax. Okay, so it means that we have to credit withholding. We have to credit the capital by 82. Okay, then there will be a withholding tax. Okay, we have to debit income tax expense. Okay, withholding tax is an income tax expense, so it should rather be like this. So we are going to get, wait, why am I debiting? No. So this is 90 and this is 82. Okay, let me see. Retained earnings, stated capital. Okay. Okay, so let's see what they did. It says the 8% tax withheld has been paid by the company and it is included in administrative expenses. Okay, they have included it in administrative. The withholding tax has been included in administrative expenses, which shouldn't be the case. Okay, so we have to reverse it. So it means we have to credit administrative expenses, okay, by the withholding tax, okay, to take it out of administrative expenses. Then we have to debit we have to debit hey, what are we even debiting? We have to debit, let me see. So we
Now we
debit
have to debit tax as an expense.
oh, okay, yeah, it's true. You have to debit tax. Yeah, as an expense. Okay. So in that case, let me see. Okay, so we debit. So when we come to retained earnings 90,000, stated capital 82,000, 82,000. Okay, listen, it's confusing me. Let me take it again. Okay, so let's read it again. So they said the 8% tax withheld has been paid by the company and it is included in administrative expenses. Okay, so let's see. So at the end of the day, the total bonus issue is 90 million, and there was a withholding tax of 72 million. Okay, so the balance of it is this. All right. Okay, now I get it. So the withholding tax actually is not the company who is going to pay. It is the shareholders who have to pay, who have to pay it. I think that's what is creating the confusion. It's like the company is paying dividends. If the company pays shareholders dividends, it's the shareholders who are going to pay the dividends, not the not the not the company. I believe you get the idea. If companies pay dividends to shareholders, as for them, they have paid. Okay, but it is the shareholders who are going to suffer the 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 withholding tax. Okay, so let's see. So the company paid 90 million. So we will debit retained earnings. Now this thing is confusing. Okay, retained earnings. Then we'll credit stated capital of 90 million. Okay, so that's how it should have been. Okay, now the withholding tax is where the issue is. So we have to credit admin expenses of 7 okay, then we have to debit what? This thing is confusing me. Let me look at how they did it. Why there's a grant. Okay, so bonus is this, withholding tax is this, net amount issued to shareholders is 82,800. Okay. So let me see what's happening to. Okay, so 900,000 bonus shares. 8% withholding. Okay. Okay, I think seeing our problem. Okay, so it means that we have to debit retained earnings by this. Okay. Then we also have to debit retained earnings by the withholding tax. Okay. Then we have to credit the stated capital by the 90 million. Okay, so 90 million. So it means that the other leg we have to credit administrative expenses by this. What else? Okay. Hello, are we there? Hi, Patrick.
Yeah, yeah,
Okay, you are here.
I'm here.
Okay, we are trying to see the way forward. Okay, so
Yeah.
this 90 million, 90 million. Okay. So let me see. Okay, so let me see something. So if they pay, so that means okay. So when they paid, debited, they credited cash and debited administrative expenses. Okay. Okay, I think okay. So let's look at what they did. The original entries they did. So retained earnings. Um, that will be 90 million. So that's 90 million. Then stated capital also 90 million. Okay. Then let's look at the withholding tax. So the withholding tax, they said when they paid the withholding tax, they debited the administrative expenses. The 8% tax withheld has been paid by the company and it is included in administrative expenses. So it means the original entry they made, okay, they debited administrative expenses like this by the okay, and they credited cash. Payment is by cash. So that's what they did. Okay, but which is an error. Okay, so debiting instead of debiting administrative expense, instead of debiting retained earnings, they debited administrative expenses. Okay. So the correct entry for this transaction should have been they should have debited retained earnings and credited cash. Okay, they should have debited retained earnings and credited cash. So this is what they should have done. Okay, this is the correct thing they should have done. Debited um, retained earnings, okay, and credited cash. Okay, so if we want to reverse it, this is what they have done. This is the mistake they have done. If we want to reverse it, it means we have to credit the admin expenses so that we'll cancel it. Then we'll debit the retained earnings. Do you get it? So the correct entry should have been correction of the entry is we will debit retained earnings. Okay, so it's like we are moving it from retained earnings. We are moving it from administrative expenses to retained earnings. Okay, credits administrative. This thing has given us tough time. Okay, so it should have been like this. Okay, so this is the correct entry. Debits retained earnings, credits administrative. So to remove the effects of that, what was the name? That error. Okay. So it means that when we come to our retained earnings, when we come to our retained earnings balance, okay, we are going to debit retained earnings of the net. Okay, that's the net amount, 82 million plus the withholding tax. Okay, which is this. Okay, then we will credit our stated capital of the 90 million. Okay, so that's how it's going to look like. Hmm. Okay, so debit retained earnings of this amount and of this amount is the capital of this amount. Okay, so I think that we have dealt with this troublesome note. Okay, let's continue. The board of directors has immediately proposed dividends. Okay, this is dividends. Now, since dividends is proposed, it has not been approved, so we are not going to account for it. Okay, since it has, but we will notice in the notes that the board of directors have proposed dividends of a certain amount. But since it has not been approved, we are not going to make provision for it. Okay, so I think we are done with our work. So let's come back. Current asset, trade receivable. So trade receivable, we know that the trial balance, trade receivable is, where is it? 177150. Okay, but remember that there is the interest accrued. Okay, the interest that accrued for the period. Okay, that interest that we calculated on the credits, which is 874.5. Okay, it will go to interest. So it will go to trade receivable. So it will be 874.5. Okay. So we are going to have 177750.
I think it's revaluation surplus. Yeah, that's why I said it's loaded. That's why I was saying it's loaded. I think the principle is, I mean, so far what we've learned. I've learned I've learned how to treat some of the items, the notes. So it doesn't have to balance for us to understand. Yeah. Mm, mm, mm. Hello, sir. Yes, please. I have to join a church meeting. You can go ahead if you put the video there. I'll follow from there. All right. Thank. All right. Thank you. Bye. I'm grateful.